Module 3. Asset classification. Plant assets. Plant assets are long-term tangible assets used by a business in its operations to produce goods or services. These assets are expected to benefit the business economically over one accounting period. As such, they are recorded on the balance sheet as long-term assets. Examples of plant assets include buildings. These are structures that are used by the business for its operations, such as manufacturing facilities, office buildings, and warehouses. Land includes any land the business owns and uses in its operations, such as a factory site or office park. Machinery and equipment. This includes any equipment the business uses to produce its products or services, such as production machinery, computers, and vehicles. Furniture and fixtures. This includes any furniture or fixtures used in the business, such as desks, chairs, and shelving. Leasehold improvements. These are improvements that a business makes to leased property, such as remodeling a rented office space. Plant assets are recorded on the balance sheet at their historical cost, which includes the cost of acquisition or construction and any additional costs incurred to bring the asset into its intended use. The asset's cost is then depreciated over its useful life, representing the estimated time it will benefit the business economically. The depreciation expense is then recorded on the income statement as an operating expense, and the accumulated depreciation is recorded as a contra asset on the balance sheet. Extraordinary repairs. An extraordinary repair is a type of repair that goes beyond the regular maintenance or upkeep of a fixed asset. It is a significant repair that extends the useful life of an asset or improves its functionality beyond its original specifications. Extraordinary repairs are not considered routine and are not expected to be performed during the regular maintenance schedule of an asset. Examples of extraordinary repairs include replacing a vehicle's engine or upgrading a building's electrical system. The costs of an extraordinary repair are capitalized, which means that they are added to the cost of the asset and depreciated over the remaining useful life of the asset. This differs from the treatment of ordinary repairs, which are expensed in the period they are incurred. The treatment of extraordinary repairs is vital for financial reporting because it can impact the value of an asset on the balance sheet and the depreciation expense recorded on the income statement. It is vital for businesses to accurately identify and account for extraordinary repairs to ensure that their financial statements are accurate and comply with accounting standards. Example: replacing the roof on a manufacturing warehouse. Disposal of an asset. Disposal of an asset refers to selling, exchanging, or otherwise getting rid of a long-term asset that is no longer useful or needed in the business. Assets can be disposed of for various reasons, including obsolescence, damage, or a change in the needs of the business. Here are the steps involved in disposing of an asset. Determine the reason for disposal. Before disposing of an asset, it is crucial to determine why it is no longer needed. This will help determine the most appropriate disposal method and ensure the asset is appropriately valued for accounting purposes. Record the disposal. The disposal of an asset must be recorded in the accounting records of the business. This involves removing the asset from the balance sheet and recording any gain or loss on the disposal. Determine the asset's fair value. The asset's fair value must be determined at the time of disposal. This can be done by obtaining appraisals or conducting a market analysis to determine the asset's current value. Calculate the gain or loss. If the asset's fair value is more significant than its book value, i.e., the original cost less accumulated depreciation, then the business will record a gain on the disposal. The business will record a loss if the fair value exceeds the book value. Remove the asset from the balance sheet. The asset is removed from the balance sheet by recording the disposal in the business's accounting records. Update depreciation. The depreciation on the disposed of asset must be updated to reflect the partial year depreciation up to the date of disposal. Disposing of an asset can significantly impact a business's financial statements and tax liabilities. It is important to properly account for the disposal of assets to ensure that the financial statements are accurate and compliant with accounting standards. Examples include donating it to charity, selling it, exchanging it for another asset, and discarding it. Deferred income tax liability. Deferred income tax liability, DITL, is a balance sheet representing the amount of taxes a company will eventually owe to the tax authorities due to the difference between the accounting and taxable income. The difference arises because the tax code allows for certain expenses or deductions not recognized in the financial statements according to accounting rules. A deferred tax liability results from the income tax expense reported on the income statement differing from the income taxes payable to the government. Payment of cash dividends. When a company owns a significant but less than a controlling interest in another company's common stock, the equity method of accounting is used. Under the equity method, the investor records its share of the investee's net income or loss as an increase or decrease in its investment account. Dividends received from the investee are recorded as a reduction of the investment account. For example, assume Company A owns 40% of Company B's common stock. Therefore, it should record its share of the $41,200 cash dividends received as follows. Debit, dividend revenue $41,200. Credit, long-term investments $41,200 times 40% equals $16,480.